The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin. Hey, there's a bubble. Welcome back to the Loonie Hour, episode 27. As always, joined by the three amigos. We got Rich Diaz, the Tom Brady of macro, delightful as always. And we've got everyone's favorite boomer, Keith Dicker, back in the saddle. Welcome back to the show, gentlemen. Just a quick announcement as before we get into the show. So for those of you who have been emailing us, following up with us, I apologize. Our day-to-day careers do not involve event planning, but we are certainly working towards it. So we have confirmed our venue for May 12th. It will be at the Sheraton Wall Center in Vancouver, downtown Vancouver, a fine venue. We'll be capping capacity out at 200 people. So $30 a pop. We will have the tickets. We don't have them quite set up just yet, but it's going to be $30 a pop. We're going to basically be doing a live podcast episode there, kind of just shoot the shit, have some drinks. There'll be a bar, some food, appies, etc. Come out, hang out. It'd be a great time. As we jump into the show, all we ask, we're getting tons of emails. The community is growing. It's amazing to sort of see the people that are reaching out, that are listening to this, some heavy hitters and a lot of people that are just learning finance too. And so all we ask is that you continue to, we put this content out for free. All we ask is that you share this episode with at least, one friend or person that you like, and let's continue to build the Loonie Hour community. But not to begrudge you to death here, let's jump into this week's show, which is really what everybody in Canada wants to talk about, is the Bank of Canada raising rates 50 basis points. We've got a Twinkie bet. I apologize profusely. I actually forgot to go out and buy Twinkies. I actually don't store them regularly at my house. It's not on my diet plan, but Rich and I did lose the bet. Apparently Rich has a Twinkie. So Rich, I don't know if you have any apologies to Keith there. And if you want to just quickly inhale this, we'll get underway.
No apologies. Even Tom Brady's lost the Super Bowl or two. So I'll just follow, all's fair in love and war. I lost the bet. Tiff Macklem does have some intestinal fortitude, apparently. And so here you go. This is a strawberry Twinkie, I think.
I didn't know they made them in strawberry.
It smells very horrible and it looks even worse. So there you go.
Just pure plastic. Oh, straight to the hips.
And it tastes okay, actually.
I gotta get another box.
And it's got this, obviously the listeners won't hear, but on YouTube you can see right in there, that's where central bank credibility lives. That squishy pink stuff.
Is it better than the wagon wheel?
Yeah, I think so. But anyway, one more bite. Oh, you can even see the holes where they inject the pink. Yeah, anyways, it's a kid's show, so I'll leave it alone. But there you go. I lost. Keith, well done. Cheers to you.
Is that gluten-free?
I don't think so.
All right. So, anyways, I owe everybody a Twinkie, so I apologize. But as host of the show, screw you. But yeah, let's chat about this 50 basis points move. Obviously, it's caught Rich and I think we were both kind of on the fence. I certainly wanted to play devil's advocate with Keith. I mean, if you had pulled me a couple months ago, 50 basis point rate hike at some point, I would probably said, nah, no chance. Clearly, this is signaling something more important. I think my personal opinion, obviously I'll divert to you guys to get your opinions, but my personal opinion is these guys should have been raising rates, 12 months ago. I think they started raising rates in March, which is officially 1 month after the housing market legitimately peaked out. So I think they're actually making a policy error, which is they waited way too long. And now I think the biggest part of the economy, which is housing, is rolling over. I can tell you from someone that works in this market day to day, housing demand is getting clobbered. It is terrible right now. new home buyers are dropping off very quickly. You talk to any mortgage broker, they're not really active with new buyer applications. What they are active with is people refinancing, trying to lock in the sort of, newfound equity they've created out of thin air over the last 18 months. And really the only thing that's kind of supporting the housing market is low inventory, because the shelves got picked dry over the last 24 months, and it's going to take some time to rebuild that inventory. So you're still seeing, the occasional house go into multiple offers, but like we're already seeing housing come off, housing demand slowing very quickly, and you're seeing prices like in the frothiest of markets. So, suburban markets or prices are already off 5 to 10% in the last 6 to 7 weeks. So, and now we're raising 50 basis points. We're probably going to get more hikes. I think, Keith and I, we talked about this off air, which is they're going to keep raising rates until something breaks. And maybe that's they induce a recession or something happens in financial markets. But it seems to me like their intent here is to send us into a recession. And so I'd love to kind of get your guys' thoughts on how you're looking at this. I think these guys ultimately are the ones that, 6, 12, 18 months ago, we're saying inflation's transitory, housing activity is transitory. It's just pent up demand from being locked in your house. They got that completely wrong. And now they're saying, oh, the economy's strong. We can handle rate hikes. Like everyone's been stress tested. It's totally fine. And I think these guys are going to be wrong again. But I mean, Keith, I'll divert to you first and foremost.
I think it's a gully. Nothing to worry about.
Oh, I love that movie.
Yeah, that's a good one. So what you guys can't see here, because I think
a lot of motivated people on this walk. Anyways, continue.
It's just a gully. Hey, I own a boat. That's another great quote from that movie. Guys, we're quoting stuff from the Big Short movie / book, which is pretty cool. So first of all, what you guys can't see here on YouTube, usually the video is just showing of whoever's talking. So while Steve was introducing the concept then of the Bank of Canada and everything, there's Rich in the background, like continuing the chow down on the Twinkie. He was really enjoying that one.
Yeah, so I'm open up a second one on the side there.
It's my cheat day. It's my cheat day.
Yeah, it looked really good. By the way, so when you see these guys in Vancouver, you notice that two of us are extremely fit looking, and then there's me. So that's what we'll have going. Let's see. So what's really interesting with the Bank of Canada's movement yesterday, we can go into that. But first of all, I want to let everyone know that the details of what the market is pricing in going forward. So right now we're at 1%. Are we at one? We're at
1%.
Yeah, we're at 1% right now. So right now, the market is basically pricing at 1% probability by October. So that's 4 more meetings from now. We're going to be at 2.5%. So 150 basis points of hikes. So they go in the order of 25 basis points for the June meeting. 50, that's half 100 for July. Another 50 for September. Then 25 in October, and then no hike at Christmas time, because they don't want to do that thing at Christmas time for everyone. So one thing that we started talking about when we start doing the Loonie Hour chat, we say, central bank, they'll keep hiking until they get stopped out, until something happens in the marketplace to do that. And so with ICEP, that's the path we continue to expect all central banks to go on. So including the Bank of Canada, the Fed, the Aussies. This morning, the Europeans, they did a bit of a belly flop. But we'll talk about those guys as well. They're trying to go down that path. But folks,
New Zealand?
New Zealand did a surprise 50 basis points hike yesterday, the day before. I forget which day it was. But everyone, the entire Western world, they're raising rates and they want to do it. And the Chinese will be cutting rates because their currency is pegged to the dollar. So they have to try to offset that. We need to talk about Shanghai, the lockdown as well. But right now, though, my main critique of central bankers, it doesn't matter if it's the Canadians or the Europeans or the Yanks, they believe they can control the economy and inflation. They firmly believe that. And even this morning, with the
And
ECB,
climate change.
yeah, they can they can control the weather as well. But even with the ECB this morning, I forget the exact quote from Lagarde, but effectively she said we have a very high degree of confidence in our skills or something to that. I tweeted that out. I forget what it was, but they believe they can do this, and that's it. So like the question I would ask any of these guys if I'm in the presser and I was allowed to ask one question, I would present them the storyline or the narrative and the evidence and data that, what if you're wrong? What if you guys cannot? The very basic and premise of your existence as policymakers is based on a false foundation. But they don't believe that. So therefore, with inflation raging around the world, it's irrelevant what or how it was caused by. These guys, they continue to believe that they're going to be able to control it, dampen it, by turning the interest rate dial. And of course, there's another way that they can fix as well, which we talk about directly and indirectly sometimes as well, which is what I think the Americans will try to do. But we'll get into that as well. I think Rich is finished.
Rich,
yeah.
Well, so I think the other thing, which we haven't mentioned yet, is that the BOC will stop. Maturing government bonds will no longer be replaced. Is that it? So I think that's letting after. After absorbing 92% of all of the government bond issuance for the better part of 2 years, they're going to stop doing that and let the maturing bonds roll over, which is the end of.
Who's going to fund Jagmeet's dental care?
I mean, yeah, well, I know they're going to raise taxes on trucks that are used to build all the houses that were supposed to. All these new policies, but anyways, they're going to end quantitative easing or whatever by letting the maturing bonds sort of roll off and not be replaced. So that's just a little bit of a wrinkle. I think it's important. The other thing I think is worth noting is that real interest rates. So what are real interest rates? Real interest rates are interest rates, whether it's prime or whether it's your mortgage rate, or in this case the main policy rate or overnight target rate, minus inflation. And we know inflation is 5.6 or whatever it is, or 5.9, or depending on its core or headline. Core is a bit lower, 3.9. But anyways, my point is that the real interest rate is still deeply negative. And so even though we've raised rates by 50 basis points, it's important to remember that real rates are still really, really negative. And on that basis, money is still easy. And the last thing I just Keith, you mentioned that the ECB said that they think they have the power. I would just say, what do you expect them to say? Like Tiger Woods was in the Masters last week. I don't know if you guys like golf or not. I'm not a big golf fan, but I'm a huge Tiger Woods fan. And they asked him, so Tiger, do you think you can win? And then he said, yeah, of course I think I can win. And it's like, that's the answer. What else? Because he said, no, I got up today and expecting to lose. I think the central banks operate the same way. I think, gun to the head, I don't think they believe they have any input or effect on the stuff. But if they say it out loud that they think that they're useless, then they have to hand back their salaries. And Steve, I don't know. What do you think about that?
I don't know if Keith's chomping at the bit there, but I'd love to expand on this a little bit further. Just because, so everyone, it was a field day on Twitter yesterday. I was just getting dunked on all left, right, and center. Because everyone's like, you guys said rates can't go up. And I was like, okay, well, first of all, let's clarify this. We had, I think all of us, in January we did the show. I think we were all making our predictions. I think we all pretty much had 3 to 4 rate hikes.
Yeah, that's right.
From the BOC this year. So they threw in a 50 there. So they're basically already at 3 this year. So I guess we've technically got 1 more left in me, and then I lose. But
also it's only April. So I would just, before everybody continues to dunk on you, let's wait until, December 31st comes around before.
Yeah,
Wink,
yeah.
wink.
Let's
I
wait
mean-
and see. Like I said, I'm only just watching the housing market and going, oh, okay, this thing's slowing pretty fast. But like everyone's like, yeah, their job is to fight inflation, and that's their only job. They need to stop supporting the housing market. And I get it. It's like, yeah, I don't think our housing market needs more support, but it kind of begs the question, like, is your job as a central banker really to fight inflation when, like, debt to GDP is at 350%? Like, is it really to fight inflation, or are you more like basically trying to maintain financial stability?
I mean, I want to step in here and then I'll be really quick. And then Keith, I know you want to say something, but so just to be clear, their mandate is price stability. In Canada, the target is 2% with a 1% range. So from 1%, yeah, that's the official target. Now, we talked about this a couple of months ago that the federal government in their infinite wisdom wants to do a dual mandate sort of by the back door. What's a dual mandate? Which is full employment, which is, having an employment component or labor market component be part of the mandate. But right now it still is only the inflation targeting. So yes, that is their job. And then Keith will tell us whether or not he thinks it's a good idea.
I mean, that's their job officially in paper,
right?
Like wink, wink, nudge, nudge. I'm going to kick you under the table. Again, I don't know, Keith. What are your thoughts?
I mean, so first of all, I think if Tiger Woods, he's going to say, yeah, of course I can win. But if you chat with any professional athlete, especially for pro golf, they know whether they have a shot to win something or not, right? So behind the scenes, they're like, man, I don't have a chance to win this. Central bankers, I don't believe they talk that way. I really think behind the scenes, they're sitting down and they really truly believe they're able, to move the levers of the economy to influence it in a good way or a bad way. One incredibly important concept for everyone to know and just remind everyone, and this goes along with with what a lot of the the big Bay Street banks, how they look at things. None of them will ever forecast a crisis of any kind. They never do it, and they're always proactive. So for everyone forecasting the central bank, so for the Bank of Canada get up to 3% and overnight rates without some kind of accident happening, it's because they just don't believe an accident can happen. And I think that's the difference between TV and reality. With reality being that something will get pushed off here. So Steve, a question for you, Steve. You said demand has dropped quite sharply over the last X days or weeks, whatever it's been. Has that been driven by the last rate hike, or like what's been why did demand dry up so quickly?
I just think it's basically been like 2 years of pulled forward demand. 2 years of pulled forward demand, and I think like ultimately like markets just end up just kind of exhausting themselves. Like we saw this in 2016 where the market just exhausted itself. And so, like I said, the market ultimately just like prices just ripped. They went like exponential, like blow off top in January, February. And I think like that was really it. And now I think it's a lot of it now it's becoming a sentiment thing, right? So then in March, you get the first rate hike, you have a huge move in the 5-year fixed mortgage. And now it's just like a sentiment thing where everybody's like reading the news being like, hey, rates are going up. Like, oh my gosh, have you seen 5-year fixed mortgage rates? Like, wow, 4%. And so now everyone's like, instead of this, like, well, I better get into the market because like prices are going to go up every single month. Everyone's now like, well, maybe I should wait, see how this plays out. And so I just think like so much like maybe what central bankers miss and these economists is like they're missing like the sentiment and psychological impact. Because like, especially housing, it's such an emotional asset, right? Like when people see prices going up and they fear that they're not going to be able to like shelter their family, they get nervous, they panic. And so they make irrational decisions and they get into bidding wars and pay hundreds of thousands of dollars over the asking price. And like I said, now when things change, they go, oh, prices come down. Like, I don't want to be buying at the top of the market. Now everybody's moved to the sidelines. And so I think that's a big thing. I think like obviously if you take the typical mortgage payment in Vancouver, so I would say, and this might sound kind of crazy for people that aren't in, say, Vancouver or Toronto, but I don't think it's unrealistic when your benchmark price in Vancouver is about 1.3 million, let's say the typical person takes on a $900,000 mortgage. Not unrealistic, very, I would say, quite common in this market. $900,000 mortgage at 2.5% mortgage rates 6 or 7 weeks ago. Today they're at 4. I mean, that's $700 a month difference in your mortgage payment. $700. So it's like, well, where's the demand coming from? And so this is why I had this like argument with one of these economists on Twitter the other day. Was like, he was like, oh, I see the Bank of Canada is going to get to 3%. That's my call. And I said, okay, cool. Like what? So I'm okay with that. So let's just play the devil's advocate here. So you're saying the overnight rate gets to 3%. In that view, how much do you think prices come down, house prices nationally? And he goes, well, none. I was, what do you mean none? He's oh, well, we got immigration and household savings rates are high and the balance sheets are strong. And I'm like, I don't know what you're looking at, but like, all I can tell you is like activity is plummeting and prices in the suburbs are down 5 to 10% already. And we haven't even really, we're just getting started. So I'm actually extremely bearish and pessimistic on housing currently. I was super bullish, as everybody knows, over the last 2 years. I'm extremely bearish because I think that central bankers, as Keith said, are going to keep going until something breaks. I think it's going to be a policy error. They're going to be way too slow at hitting the brakes or hitting the pause button. Just like they were way too slow in raising rates. What they should have been done is cooling the housing market 12 months ago.
Steve, just to reiterate, so what I heard from you then was that your mortgage payment from before rates started going up to, I guess, yesterday, before we had the rate hike, for the average mortgage of $900,000, your payment is $700 more a month if you're getting it today versus a month ago.
Yeah, exactly. Like, so I think to frame that up, just again, so everybody understands, if you're like a prospective home buyer and you got to buy, so you got to get a new mortgage, you were at 2.5 6 to 7 weeks ago. Today you're at 4% on a $900K mortgage. That's $700 extra per month in your monthly mortgage payment, and you're getting the exact same house.
Just look at it from a different perspective. Let's just say your payment stays the same. How much has your ability to borrow been reduced? So instead of 9 million, maybe now it's what, 850, 860?
Well, yeah. So no. So a little bit of caveat there is that so we have the mortgage stress test, which is actually brings that to another fantastic point. So the mortgage stress test, the minimum, so they always qualify you. So if you're borrowing at 1.5% mortgage rate or 3% or whatever, they always qualify you at a minimum of 5.25%. So they say, well, how much can you afford if mortgage rates were 5.25% minimum? So that's the minimum rate, or it's your contract rate plus 2%. So what that means is now that mortgage rates are 4, if you say, I'm going to go and get a fixed mortgage rate today, they're going to stress test you not at 5.25, but they're going to stress test you at 6%. So you've lost purchasing power, which is why you're seeing more people now go variable rate, because the variable is still only 2.5%. And so they're saying, well, I better go variable because then I can qualify for more, because if I go fixed, I get stress tested at a higher number.
You just reminded me of
the light bulb just went off for me.
Rich is dreaming about Rich. And again, if you're not watching the YouTube, you have some Twinkie cream up on your face.
No,
Thank you. Can I add something there?
Thanks,
quickly?
Mom. Yeah.
Yes, please.
So I was laughing because I'm watching this Bank of Canada presser, and like Tiff Macklem like dodges the question, gives it to Carolyn Rogers there. And because they're asking her about the housing market, and she goes, well, we see housing activity moderating. It will remain high, and we don't see this being a drag on the economy. And oh, by the way, all these borrowers are stress tested, so they can weather higher interest rates. This is not a problem, guys. And I'm going, the stress test is the biggest joke of a policy, because every particularly young buyers in like Vancouver, Toronto, which is like your two biggest, most important housing markets in the nation, all of them obviously are making like, what's a new buyer making, like 60, 70, 80,000 bucks a year. You're like, you can't even get a condo for like $500,000 bucks. So they all have to basically get their parents to co-sign their mortgages. And every parent basically hands little Johnny $100,000 check as a gift down payment. And so like, that's how they get around the stress test, is to get mom to co-sign the mortgage. And mom also hands $100,000 check. And now Johnny like is it affords and is stress tested for that condo purchase. Like, are you actually stress testing Johnny? Like, no, you're stress testing his entire family. Like, Johnny can't afford rates at 5.5% if they go up. But like, this is what the policymakers are saying. It's insane.
But can I circle back just to Keith's comment? Because sorry, Keith, I gotta push back. I mean, you started out by saying, that the central banks, they don't have any control on the market. And I think I understand. I love hyperbole as much as the next person, but I mean, Steve just laid out a case where they clearly do. And I could give you two other cases where they clearly do. Paul Volcker in the 1970s raised interest rates by 10, 15%. He induced a recession. He was truly probably the last independent central banker, because Richard Nixon went to his office and said, please don't do this. You're going to destroy my re-election chances. And Richard Nixon didn't need anybody's help to ruin his own election chances. But anyways, Paul Volcker raised interest rates and induced a recession. Two, you can argue, and broke the back of inflation. That was a central banker. Similarly, in 2008-9, Ben Bernanke, I remember watching the press conference where he's drinking the water in front of the Senate Banking Committee and his hand is shaking, and they're asking him questions about whether or not the global financial crisis is going to ruin the Western democracy and our civilization. And he, takes a sip of water and his hand is shaking and he says no. And then he goes on to basically execute the playbook of the 1930s with quantitative easing. So this idea that central bankers, don't have control over the economy, I think I get what you're trying to say, but I just think for listeners who might not be as aware of the nuance, I mean, they do. I mean, where I do agree with you is they clearly overstate two things, which we should all be aware of. Steve pointed out one, which is their ability to forecast anything ever. And then two is how much they have an impact on the economy. I mean, they have one lever, sometimes two, but one lever. And that lever obviously can impact certain buying decisions, housing. But the key thing for all of us to remember is that they just are not good at forecasting or thinking on second order effect, or even thinking around the corner, as Steve, I think, has laid out really well.
You see that?
So Rich is obviously having a bit of a sugar rush to his head right now.
Okay, I want to hear your retort to this. I'm totally right about that.
Holy smokes. So let's just back up a little bit. Let's just go most recently, and then we'll come back a little bit further.
Please don't use Christine Lagarde as your example for a central banker.
No, she's an example for other things besides banking. So back in April of 19, right? So this is before stuff has happened. Chairman Powell at the Fed: low inflation is one of the major challenges of our time. We can't fix low inflation. Janet Yellen, her only regret as the Fed chair was low inflation. We couldn't raise inflation. Brainerd, she says the same thing. She calls for a new strategy to boost inflation. Like they're trying to increase inflation. New York Fed President John Williams says low inflation is the problem of this era, right? So let's just, and people say, oh, well, no one saw COVID. That is crazy, all that stuff. But
the Chinese saw it coming. But anyways.
Yeah, well, of course. Dun, dun, dun. Dun, dun, dun. And the lights just went out on the Loonie Hour.
Sorry. I've been banned in a couple months. There we go.
That's all, folks. There we go. My response, again, central bankers, if you really believe they're able to influence the economy, first of all, we would not had an 08-09 housing bust. Okay, but let's just say we did, and that's all of a sudden they realized, yeah, you know what, we can now influence the economy and all that stuff. So for over 14, 15 years now in some economies, they've had zero and negative rates and QE. They bailed out the banks, the auto companies, and you name it around the world. all with the goal of trying to accelerate economic growth enough to offset the growth in debt, to help central banks get back on their feet, help everyone else get back on their feet, and with their main goal to produce inflation, not bad inflation, good inflation, which is wage growth, which doesn't cause the price of stuff to go up. So think about it. They've been doing this for almost 15 years, and the result, zero. They failed miserably because at the end, as I just demonstrated for these guys, they all said, oh, we can't solve this low inflation problem. You go back to Greenspan. Remember his big conundrum? You guys weren't around back then, but back in the late 90s, he his word, he mumbles a lot of things, of course. And he said, it's a conundrum. He couldn't figure out why growth is so strong and inflation is low in the world. And it's simple. You get these very long-term secular movements in markets and demographics and all that stuff. And if you go back to the 70s and, you have Volcker, I think if you were back living in those days, he would not be the rock star that everyone claims that he is today. He just got caught in a time where, they had the energy embargo. Life was different back then. A lot of things were struggling and whatever. And all of a sudden, it all rolled over into the 80s because then it was, I'm an 80s boy, so it was cool back then to do things. But things slowly started to improve and change. So my comment all the time these days that policymakers, they're not able to create this kind of inflation or move the economy in one direction or the other. They can change things at the fringe, but my view is that the only thing that they can create, and they have one lever, and if you can look at their lever, it's not interest rates up and down, it's a bubble lever. And if they move it down, it just means that the bubble is getting bigger. If they move it up, it's going to get even bigger, if that's the right word. So you can tell guys, like it's not that I'm not a fan. I've met some of these guys before, like really nice people. They have families and friends and stuff like that. And they really are trying to do good for everyone. However, and again, to reiterate this, we've reached the end of this 40-year cycle of interest rates going down. Whenever there's a crisis of cutting rates and then doing QE, bailing out this and that, and everyone thinking it's a normal cycle, we'll rebound with this or that. I think it's insanity. We're going to hit some kind of bump along the way. And it's a great opportunity to make money. It's even a better opportunity to avoid the potholes. Again, like you don't have to be afraid and cower in the corner or anything, but just recognizing that, again, the central bankers, they always react. So right now we think the central bank, again, we'll pick on the Bank of Canada, they're going to get up to 3% overnight rates. And as Steve, as your friend said, they'll have zero effect on the housing market. Like, what planet are they on? Like, it doesn't.
Well, they do have an effect. So you just contradicted yourself.
No, but it's the belief that they can cause only good in the world.
Oh yes, no, we are definitely on the same page on that.
Yeah,
I think there's just way too much.
If they knew they were going to cause a crisis by raising rates from a quarter point up to 3% over 9 months, like they're not going to do that.
No,
again, like it's just not normal behavior and these people, they can make life miserable for a lot of people in the world, and they're not trying to. Again, they're trying to do good things here, but I'm just really concerned. And like everyone who watches our show, and like at IceCap, I tell everybody when they become clients that, what's really great is that, the majority of our clients were all really engaged with what's happening in the world. Everyone's intuitive. No one has figured everything out, but we know that, hey, don't go down that road. That looks dark and bumpy. This road looks awesome. Let's go that way. But unfortunately, the majority, not 50 plus one, but like 95%, 99% of the investors out there, they have no idea this stuff is happening, and that's where the shame is. That's my rant, guys.
Yeah, we definitely agree on that last one. It was a good rant.
You know what I call those people? Believers. They just believe like this. They drink the Kool-Aid, the faith in like policymakers, and they believe in, like, I don't know. I say they believe in the system. They're like, oh, we can just raise rates to 3-4%. Let's go back to normal interest rate policy, and everybody can sing Kumbaya, and house valuations will be fine. And we believe in Tiff Macklem. Whatever he says, the economy can withstand. It's all good. And I think that's like a lot of these like economists, they're just like like believers. And I think let's call a spade a spade. I mean, we've been running zero interest rate, a ZERP, zero interest rate policy for the past over 10 years now. You've been running QE since 2008. I mean, it's a sick economy. It's global debt to GDP is at 365%. Like it's on life support. Like there is no normalizing policy and going back to like the good old days. Like I'm sorry, it's not going to happen. And so that's why like every time these guys start to normalize policy or try to, like something goes wrong, something blows up, and like that's really like the point we're trying to make. Is like stop looking and paying attention to these guys that are saying, oh, you know, the stress test is going to keep everybody safe and we'll just raise rates to 4% and everything's going to be fine.
So there's one more thing that I think both you guys are not going far enough, where I agree with Keith 100%, which is not only, you know, is their self-belief really strong, but they just never admit when they fuck up, right? Because if I wrote down, you know, I was looking at Tiff Macklem on July 15th, 2020, he said interest rates would be low for a long time, blah, 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 and basically insinuated, or, you know, basically not in so many words, but basically told Canadians to lever up. And then not shortly,
he actually said if you lead, because like you look, they went deeper into that conversation and his monetary policy report at the time, they were basically saying like they wouldn't start lifting rates till the end
yes,
of 2023.
Thank you. That's exactly right. And then the other thing, so that's one point that I think, I mean, Keith, you're too polite. I think you should have, you know, stepped on the bug a little bit harder, but I think that's one thing. And the other thing is, how quickly we forget about the transitory conversation that we were told last year. You know, Loonie Hour listeners will remember that some of us crusaded against that. And I think
how many episodes did we do on inflation? Like when we first started, everyone was like, "You guys!" Like every weekend, it was like inflation. And
no, remember that's true. But anyway, we shouldn't dwell too much time on this. I think that the point I wanted to reiterate from what Keith's point said was we should be very, very skeptical of these press conferences and what they have to say and their views and their ability. I think that they're very human, and they don't act like it, I think is what I would just say.
Anyways, housing is going to take a dump because we're controlled by incompetent people. I don't see how by raising rates, they're going to be able to plant more corn and wheat and you know, drill more oil out of the ground. But that's what they're trying to do. They're going to raise rates to basically induce a recession. I don't know if you know, Keith, are you looking at anything in particular right now in financial markets? Is there anything that's screaming to you, hey, red flag here, signs of stress, or is it kumbaya? What are we looking at right now?
Yeah, it's not kumbaya. So our two main equity models that we use, and there's no subjectivity built into it, like valuation models or earnings estimates, you know, GDP growth, you know, those things that, you know, the CFA world taught me a long time ago were the most important. And I've since changed my view on that. But our two main models, that they basically measure, you know, the strength of the market, you know, good old housing market stuff, right? Supply versus demand and trend and momentum. So our two main models for that, you know, they're still suggesting equity models, you know, they're soft here. Sorry, equity markets are soft. They could remain soft. We're not able to predict, you know, a sharp market sell off or anything like that. But in general, though, we are being, you know, cautious towards that part of the market. But on the flip side of it, you know, agricultural commodities, you know, continue to just surge higher. That's gone pretty well for anyone in that space. You know, we suspect, you know, we're going to, you know, see these movements continuing. Fixed income, it's a nightmare, guys. So like, and again, if you go back to like any typical Canadian bond fund, the average bond is probably has a maturity of 7 or 8 years in it. There's credit mixed in with it as well. I'm just guessing. I'm assuming the 1 year return is maybe down 10%. Is that right, Rich? Do you follow those?
Yeah, duration. Obviously, the more duration you have, the probably worse performance you got. But yeah, it's 5, 6, 10%, 11, 12%.
It's tough. So in a world that say it's, is yielding 3%, like that's 3 years of income is wiped out, plus there's some capital erosion on it. And I keep going back to, there's a huge difference between the market and the industry. And it's the same thing in the US, Australia, and Europe and all that stuff. But the industry, it's pretty bad because it always guides older investors, people who are entering the retirement years, or people who are conservative, into the bond world, because that has less risk, what they call it. But if you lose 10% on a low risk strategy over 1 year, that ain't low risk. So again, it is pretty tough, and risk only manifests itself with hindsight, of course. But the Canadian, the banks, mutual funds, and insurance guys, you have a duty to make sure investors understand and appreciate what risks are out there, and don't just flog funds to people, products, because there's real people here at the end of it. So again, very conservative investors, they got crushed over the last year. It's not good. It's not nice. I'm not fun today, am I? I need a Twinkie to maybe make me feel better.
Man, I'm sad just listening to that.
I know.
Okay, well, let me make you feel happy.
Yeah, let's go.
Grandma's about to go through a food shortage crisis there too. So we'll talk about that in a second here. But Rich, what are you looking at?
The market things I think were interesting. I mean, we talked about what's priced in the Canadian market. We didn't really talk about what's priced into the US market. I mean, it's probably another 150 basis points, 200 basis points. We talked about it not getting anywhere near to that because something will break. I agree with that. But one thing that's, I think, interesting on the markets, things I'm looking at is, we talked about the yen a couple of weeks ago. The yen continues to sell off. So we're at nearly 125 on the yen. I mean, that's, relative to some models, you could say that's 25% undervalued, or it's just going to keep selling off because, as we discussed, the economy is in real trouble. But one thing I think is really fascinating is the defensive sectors. So there's different types of equity sectors. We've talked a lot about growth. We talked a lot about value. There's certain things called cyclicals that people might be familiar with. Cyclicals would be things like industrials, materials. Some people say that tech is a cyclical. Who knows? That's a conversation for a different day. Consumer discretionary. And then there's other stocks that other sectors that fall into the defensives category. And what are defensives? There are things like other sectors and companies that are healthcare or consumer staples, utilities companies are so-called defensives. And so what does that mean? It means, it's exactly what it says on the tin. Now, does this always work? Does it not always work? Who knows? I mean, that's a conversation for a different day. What I think is really fascinating over the last 2 or 3 months is that defensives are actually started to not only outperform cyclicals, but have actually gone up almost 5%. And so I think that's just something I look at a lot. I look at relative performance. And so that's really, really interesting. Keith always talks about not being afraid and finding managers and strategies that can outperform no matter what's happening. And I think he's 100% right. And that's definitely possible. And one of the ways I think right now is doing really well is defensives. And then also value. There's the growth to value tint. That rotation continues to happen. The other thing that I think is really interesting in the market standpoint is we discussed emerging markets a couple of weeks ago. Not all emerging markets are created equal. Some of them that are tied to commodities, specifically oil, are doing really, really well. So two of the best performing equity markets this year are Brazil and Chile. Canada is actually one of the better performing equity markets, and so is Australia. And these are all tied to, and these are up on the year. And in many cases, lots of people's portfolios are down, and these different equity markets are actually doing really, really well as a function of their exposure to materials and energy. I don't know if you guys have any other ones.
One more thing to chat about, not a big deep conversation, but the lockdowns in Shanghai. You know, a lot of people are following that. So Shanghai is one of the largest ports in the world. I think the volumes are about 4 times that of LA, and LA is a massive port. You know, it's a bit bigger than the one in Halifax. And so we, you know, with that, if it continues and it spreads to other ports, like the odds of inflation actually continuing higher, it's increasing. It's there. And I don't think it's maybe not getting the airtime yet. So if you feed all that through, you know, again, maybe it's one of these other events outside of Canada that could cause, you know, housing to get even a bit more stress on you in the near term. And then the other thing, last week we mentioned it, again this week. So we had the first round of the French election last weekend. It more or less came out the way that everyone expected it to. So what over there, you know, every party leader, you know, they're involved in round one. And if one individual gets 50% plus one, then it's over. You know, they become, you know, president. If they get less than 50%, then there's a runoff between the 2 top parties. And that's what always happens in French politics. So right now, the final runoff, and what they do very well, is very short. It's 2 weeks, 2-week turnaround. It's not like the American system where it's like 4 years running into it and, you know, who knows what goes on. So not this weekend, but the weekend after, it will be the second round. And right now, it's looking as if there will be no change. So Macron will get reelected. However, there is a probability that Marine Le Pen, that she could win. I think is a very low probability. So it's not a 0 probability event. It is non-zero, but a very low one. However, if she does win, if she pulls it off, you know, 10 days from now, that will be the political event, bigger than the whole Trump victory back in 2016. This thing will just rock Europe and the Eurozone. And Monday morning, they'll have to stop trading in euro. Like that's how
parity for sure.
Yeah. Okay, I think euro right now is about 108 points away from our target. You know, that's where.
What's your target?
108 points away from the current price.
Oh, excuse me. Sorry. Like 1%.
No, 0.
Oh, okay.
That flew over your head. The current price of euro is 108.
Okay.
Okay. So
your target is 0. Got it. Yeah, sorry, I missed that. You're too fast you're too quick for me, Keith.
I know. Boomer is too fast for you guys these days. We'll have to slow.
No boomer jokes. We'll have to save those up for the event here, May 12th.
Wait, there's another thing we forgot to mention, which was the U.S. CPI came out, the U.S. inflation. So as Canadians, as Canadians worry about inflation, inflation hit, I think 8.5, right? In the U.S.,
8.5. I mean, I think Canada. Tiff Macklem said that they're expecting inflation to average like 6% in the first half of this year. So that's obviously
which makes me think that we probably peaked on the, to channel my inner Keith here. It makes me feel like we peaked. Inflation impulse is probably behind us.
Would you not think though, from like a rate of change perspective, that inflation basically has either peaked or will peak next month?
Yeah,
basically.
Yeah, totally. That's internally. That's what we've been discussing. We were probably off. We were wrong by 1 month. I think we would have said it was this month. But next month, it's just very, very difficult to maintain that relative, that year-on-year performance. That's not to say that it's going to make anybody feel any better when inflation hits, 7 year-on-year. It just means that you're right and the impulse is over. But the other thing is the PPI as well, which is something that gets a lot less press. The PPI is the producer price index. And that hit, 11% and 8-9% for services. The thing that caught my eye was, and I love American politics, so I'm always sort of paying attention, but the press secretary blamed the inflation on Vladimir Putin, which I thought was as big a lie as anything we've heard in the last administration. I think it's just outrageous comment, which I couldn't help but share with you guys. It's a part of the story, but it's just such a shameful lie.
That's how the Bank of Canada started yesterday as well.
That's right.
Yeah, dude, I was going through like left-wing liberal Twitter. Again, I don't really care about your politics, but like then they were saying the same thing. They're like, oh yeah, see, like Putin, like everyone was blaming Trudeau and his deficits, and blaming poor Tiff Macklem. Like this, none of this is out of his control. None of this is in his control. I was like, dude, you expanded the monetary base by 25% in 2 years,
and ran a deficit of 10% of GDP, which was twice that of the global financial crisis.
It's like we had massive inflation and massive devaluation in the currency, which showed up in house prices well before this war in Ukraine. It's actually very concerning. I mean, some of these people, and they're allowed to vote. It's like, holy smokes. But that's why we do the Loonie Hour.
I know that's why we do the Loonie Hour, but I just, to me, it's just so Keith's going to make fun of me now, but it's just like, do they have to lie? Do they have to? Like, why? Just be honest with us. We did what we thought was best at the time. We over-egged it. Now we're all paying for it. Yes, Vladimir Putin's a jackass. Like, you know what I mean?
Yeah, exactly. Now we're gonna try to rein in the we're gonna try to take away the punch bowl here. We gave everybody too much. Oops, our bad. We're gonna try to rein it in. And by the way, this is not gonna be easy. Like,
Keith, tell me how naive I am.
I mean, not at all. I mean, it's always about money. So you have to deflect the blame. So blaming. Again, everyone always laugh. Oh, it's funny how it doesn't matter if you're Canadian, American, or wherever else. Everyone is now caught on to if you're a politician and it's your benefit to deflect attention away from the inflation story. Everyone's calling it the Putin price hike. And as you pointed out, inflation seemed to be ripping up pretty good prior to the Ukraine crisis. But now all of a sudden everyone is, oh no, it's all based on that. And before that, it was the truckers' price hike. And before, keep going on.
I forgot about that.
Yeah, you're not supposed to talk about that anymore. But see how convenient, it is just to shift, the attention away or the focus.
And then COVID, which is the worst it's ever been in Halifax. And yet, no masks.
COVID's going up and
Shenzhen. I mean, that could be. I don't know. We talked about it briefly, but it could be an issue. I mean, there's lots of what is it? Someone was saying 19 of 23 large cities in China are under lockdown measures, and it's last time we checked is a lot of the world's stuff is manufactured in China, so supply chains, etc., could come under more constraint. It's kind of just, I mean, obviously. Yeah, terrible time to be a central banker.
You know what to say, but we go back to the whole Shanghai lockdown is because of that. Whether I don't know if I think the Canadians would absolutely go back into full lockdown mode again if they could. What I mean by that, politically and socially, that's what Canadians want to do in most parts. In America, oh boy, you'd have the blue versus red states doing it. So, but again, if the Chinese remain locked down and it affects other countries, again, we're going to be in this. Hey, here's a boomer story for you. I need a good story.
Yay, boomer story. Wrap it up.
I've been using the same deodorant since I was 6 years old.
I didn't think you used deodorant, but yeah,
I know I was aging quickly. I can't find it. It's been gone now for 18 months, and I've been going now for a few months without it. But I know. But I'm looking around and say, why is mine gone? So I got to try to find it. I won't tell you which one it is.
I was gonna say, if you're gonna get cases sent to us by our
I wonder what it smells like. It just smells like old man or something.
No, it's really nice. It's like a nice morning smell, and it livens me up.
Are you sure it's not woman's deodorant?
It might be.
Mrs. Ice Cap. All right. Well, I think it's a good way to end it there.
Can you cut out the last 3 minutes? Cut it out, yeah.
Yeah. Hey, Jeff, our editor there. No, just kidding. Jeff, you can leave that in. God bless. We appreciate the support as always. Like we said, May 12th is the event. We'd love to see as many people come out, obviously, to Vancouver here. Like I said, throw back some drinks, have a good time. We'll announce the tickets in terms of we'll basically be able to provide a link so everybody can go, purchase your tickets, $30. We're not making money here, guys. We're just trying to cover some of the bases. Keith is only so rich. So May 12th, as always, we appreciate your support, and we'll see you next week.